I trust you're all well. For those of us in Melbourne, our time is coming. We are close. My name is Paul Sokolowski. I'm a partner at Arnold Bloch Leibler and the leader of our taxation practice. We are very happy to be presenting the fourth webinar in our webinar series, Quick Takes on Tax. Welcome to our overseas guests and all of you situated in many parts of Australia. We pay our respects to the traditional owners of this land and their leaders, past, current and future, with whom we can walk together in a movement of the Australian people for a better future. Some further housekeeping before I introduce our speakers today. Your videos, audios and the chat function will not be enabled during this session. You will not be visible to anyone else on the webinar. We will address questions at the end, and if you have any questions, please use the Q&A button at the bottom of your screens to type in questions during the course of the presentation. If you can, do it during the course of the presentation, not right at the end. It might be more convenient for you to do it that way. We'll get to as many of those questions as time permits. Now, the topic of the day. We are finishing up our webinar series with a survey of changes and things to watch out for in two important areas: the world of state taxes, particularly in Victoria and New South Wales, and the developing and increasingly challenging landscape of the FIRB investment rules. To take us through these provisions, I have great pleasure in introducing our presenters today in order: Zoe Chung, a special counsel in our tax team and our expert in state taxation laws across all Australian states and territories. Zoe will deal with topical state tax issues in Victoria and New South Wales. Our second speaker is Mark Mcrae, a senior associate in our tax team, who will take us through the developments in Australia's foreign investment regime. Zoe and Mark, please lead us in a discussion in these two areas.
Thanks, Paul, for your introduction, and thank you to everybody for joining today. So I'll be starting off with the recent changes to foreign purchaser surcharge and discretionary trusts. Most people would be aware of the foreign duty surcharge that applies when a foreign person acquires residential property in Victoria. With respect to discretionary trusts, there is a broad legislated concept as to how a discretionary trust can be characterised as a foreign trust, which essentially is that if any potential beneficiary of the trust is a foreign person, then that would make that discretionary trust a foreign trust. As such, when the surcharge was first introduced, the Commissioner announced that he would not strictly apply the definition to family trusts, and he would apply what he termed a practical approach. In short, under the practical approach, the Commissioner said that whilst a discretionary trust may have potential foreign beneficiaries, he would not practically consider the trust to be foreign if it was satisfied, amongst other things, that the foreign beneficiaries had not received any distributions and were unlikely in the future to receive any distributions from the trust. In my mind, relying on a practice of the Commissioner that's contrary to the words of legislation was something that was fraught with danger. In any event, the Commissioner has now expressly retreated from this practice. As such, subject to some limited transitional provisions, mainly applying to contracts entered into before March this year, most discretionary trusts will need to have an express foreign beneficiary exclusion clause in order to ensure that they will not be considered a foreign person and therefore avoid the imposition of the surcharge. I might just make a quick note here that the concept of what is foreign for duty purposes in Victoria is different to the concept that's relevant for the land tax surcharge in Victoria. So I might just move on to New South Wales. New South Wales has also recently changed its treatment of discretionary trusts for foreign surcharge duty purposes. Previously, New South Wales adopted the FIRB concepts, although tweaked a little bit, as to when a discretionary trust would be considered foreign. It's broadly the same concept that applies in Victoria. However, pursuant to a recent Amendment Act, effectively in New South Wales, unless the discretionary trust deed contains an express foreign beneficiary exclusion clause, and that exclusion clause cannot be amended so as to enable a foreign beneficiary to benefit in the future, then that discretionary trust will be deemed to be a foreign person. Further, as part of this amendment, New South Wales also tweaked the definition as to when a foreign person could be said to be a potential beneficiary of the trust by adding that if a person could benefit if the trustee failed to exercise a discretion, then they would be considered a potential beneficiary. This addition might not seem significant, but arguably it was open under the previous concept that a failure to exercise a discretion would not mean necessarily that a person held a relevant interest, as arguably the trustee did not have a power or discretion to distribute to that beneficiary. Even though it might seem unlikely that a foreign person could be a taker in default and not a beneficiary of the trust, this may not be the case under some default provisions and how they've been drafted, such as where successive taker in defaults are identified by way of their relationship with a primary taker and not as to their character as a beneficiary of the trust per se. For example, in some deeds, the primary taker is identified as a specified beneficiary, but successive taker in defaults are characterised as lineal descendants pursuant to succession acts. In those cases, potentially an exclusion clause that focuses on excluding foreigners from the definition of a beneficiary may not actually exclude takers in default that are not takers by reason of being beneficiaries, but are takers by virtue of a defined concept. So, what to do? For both Victoria and New South Wales, if you haven't done so already, it would be prudent to check your trust deeds. Are there any foreign beneficiaries? Is there an exclusion clause in the deed? And if not, you should probably consider adding one in. If there is a clause, is it sufficiently broad enough to cover all the ways that a person could benefit under the trust? Also, before deciding to amend your deeds, it would be prudent to check to make sure that the amendment itself doesn't give rise to any tax or duty implications. With reference to stamp duty, changes to default beneficiaries and even potential objects could have duty implications in some states, such as Queensland and South Australia. So before you commit to any amendments, be sure to check where that trust holds any assets. Relevant to New South Wales, there are also some transitional rules in place that allow you to seek refunds of duty and land tax surcharges that have been paid in the past. The deadline for this is 31 December this year. I'll now change tack a little bit and move on to some of the Victorian COVID-19 related relief measures. As a result of the challenges that the COVID-19 pandemic has brought to the Australian economy, the state and territory governments and the federal government have put in place a number of emergency fiscal and tax relief measures. I'll only be discussing the ones that are Victorian related, and I'll be focusing on land tax, vacant residential land tax, and payroll tax. However, there are a raft of other measures that are available, including a bring forward of a 50% stamp duty discount on acquisitions of commercial and industrial property in regional Victoria, the Commonwealth Home Builder Program, which is being administered by the states and essentially offers a $25,000 grant to eligible new builds and substantial home renovations. There are also various other waivers, such as a waiver of liquor licensing fees, congestion levy relief, and some other limited motor vehicle type relief as well. So starting with the land tax measures, they are mainly targeted at landlords with limited application to vacant properties and owner-occupied commercial properties. There are two main types of relief, one being a deferral of the payment of land tax and the other being an actual reduction to the land tax liability. For the most part, the eligibility criteria for both commercial and residential landlords mirrors the rent relief codes of the Commercial Tenancy Relief Scheme and the Residential Tenancies Dispute Resolution Scheme, and effectively requires that the landlord has provided their tenant with relief in accordance with those codes. But there are also some land tax specific eligibility requirements. Similar to how the restrictions in Victoria have been quite an iterative process, the land tax relief available has also changed as the economic situation in Victoria has evolved. It started as a 25% reduction to the 2020 land tax liability, and broadly, this required landlords to pass on, in dollar equivalent terms, the same saving to the tenant in rent relief. For example, if your land tax liability was $10,000, then you are required to show that you've passed on $2,500 to your tenant in rent relief. This was then increased in August to a 50% land tax reduction, but the eligibility criteria was slightly changed. Unlike the 25% reduction, to access the 50% reduction, you must show that you've provided a 50% rent waiver to your tenant. In other words, it's not a dollar pass-on equivalent. In August, there was also an extension of land tax relief to certain owner-occupiers, as I mentioned earlier. Separately, if a landlord was eligible for the land tax reduction, they are also eligible to defer the payment of the balance of their 2020 land tax assessment until March next year. Then most recently on 13 September, there's been a further extension to the land tax relief measures, essentially to mirror the extension of the residential tenancy relief scheme to March 2021. In this new announcement, residential landlords who provide rent relief to their tenants into 2021, consistent with that scheme, are eligible for a 25% reduction to their 2021 land tax assessment. Whilst not much information has been made available in relation to this new measure, it would appear that it's likely going to be similar in format to the original 25% reduction that's available in relation to the 2020 land tax assessment. In other words, you'll likely be required to pass on an equivalent rent reduction to your tenant that is equal to the dollar amount of a 25% land tax reduction. You'll also be able to defer the payment of the 2020 and the 2021 land tax assessments until November 2021. As of today, it's presently unclear as to whether this new 2021 land tax relief will be available to vacant properties, and at this stage it hasn't been extended to commercial landlords. I might just pause here and make a quick comment about the land tax relief in other states. Each state and territory has come up with their own variation as to what relief, if any, it'll give to property owners. Briefly for New South Wales, my understanding is that there's a similar 25% land tax waiver available to commercial and residential landlords, and that this has just recently been increased to an additional 25% reduction. In other words, a total 50% waiver is available subject to the rent relief conditions having been satisfied by the landlord. It's also important to note that for both Victoria and New South Wales, the land tax reductions only apply to the general land tax that's chargeable. If any foreign or absentee surcharge is also payable by a landlord, there is no reduction applicable to the amount of that surcharge. I'll now move on to vacant residential land tax. As a brief overview, vacant residential land tax is a separate tax to the general land tax, and it applies to homes in inner and middle Melbourne that have been vacant for more than 6 months in the preceding calendar year. The rate of vacant residential land tax is 1% of the capital improved value of the property. I note here that if a vacant residential land tax is actually chargeable, the amount is likely significantly greater than the general land tax that also remains applicable. This is because general land tax is levied at scaled rates on the unimproved value of a property, whereas vacant residential land tax is chargeable on the capital improved, or essentially the market value of the property. As such, whilst a 1% surcharge might not sound high, it can actually translate to quite a material additional impost in any given year. As to whether a property has been relevantly vacant for the purposes of the vacant residential land tax is assessed by calendar year, so 1 January to 31 December concept, and the 6 months of vacancy do not need to be continuous. So, in recognition of the significant restrictions on travel and mobility that the COVID-19 pandemic has brought on, such that until most recently, in-person property inspections are not possible, it means that many developers will be holding onto stock for longer than anticipated, and many rental properties may still be untenanted. As such, the Vic government announced a full waiver of the 2021 vacant residential land tax that would ordinarily be applicable if the property had been vacant for more than 6 months in 2020. The last thing that I wanted to briefly cover is payroll tax. Similar to land tax, the payroll tax relief that has been made available has been iterative and consists of waivers and deferrals. The accessibility of a payroll tax waiver is relatively limited. It's limited to employers with a less than 3 million in total Victorian taxable wages. It is assessed on a per employer and not a group basis, but if you're eligible, it is a full waiver of the 2019-2020 payroll tax liability. Those eligible employers were also entitled to defer the payment of the first quarter of the 2020-2021 payroll tax liability until January 2021. Since then, there's been an extension to the payroll tax deferral relief that's been made available. Now, employers with up to $10 million in Victorian taxable wages are now able to defer all of their 2020-2021 payroll tax liability until the 2021-2022 financial year. Whilst this is welcome from a cash flow perspective, it doesn't actually give any reduction or waiver of the payroll tax amounts. It's merely a deferral. Effectively, it means that those employers that do elect to take up this deferral will end up paying double the amount of payroll tax in the 2021-2022 financial year. Similar to the original $3 million threshold, the $10 million threshold is assessed on a per employer and not on a group basis. The last type of payroll tax related relief is that the SRO has determined that gap payments between an employee's normal wage and the amount that the employer is required to make as a JobKeeper payment are exempt from payroll tax. Additionally, if an employee had been stood down and does not perform any work, then the full JobKeeper payment would be exempt from payroll tax. So that's all I wanted to cover today, and I'm now going to hand over to Mark to discuss some FIRB things.
Thanks, Zoe. That was interesting and alarming in equal measure, I think. Now, as Zoe and Paul have mentioned, I'll be speaking about Australia's foreign investment regime, which has been making headlines this year because the COVID pandemic triggered a substantial change with the removal of monetary thresholds for foreign investments. But it should be borne in mind that the government has been steadily increasing its scrutiny of foreign investment over the past few years, and a suite of reforms were announced in June, which, if enacted, will have a much greater impact on foreign investment going forward. So today I'll be giving an overview of the regime, but also discussing some of these proposed changes. Now, to set the scene, I think I'll start with a statement which is usually the first thing that the government says in any statement concerning foreign investment, and it's that foreign investment is important for Australia's long-term economic success, stability and prosperity. And this is clearly borne out by the facts. At the end of 2019, DFAT estimated that foreign economies had a total of $3.8 trillion invested in Australia. Now, while investment from China might rank #1 in terms of press coverage and community interest, it is only #9 in dollar terms and represents just 2% of total foreign investment into Australia, compared with 25% from the United States and close to 22% from the United Kingdom. The benefits of foreign investment, though, have to be weighed against the potential risks they pose to Australia's national interest. And responsibility for maintaining that balance rests with the Treasurer, who is assisted by the Foreign Investment Review Board and other components of the Treasury, the Australian Taxation Office, and other government agencies where their expertise are relevant. Now, the balance is maintained by the application of the national interest test. The criteria by which the national interest is assessed were deliberately not enshrined in the legislation, so as to allow the government of the day flexibility in applying the test to the particular circumstances and in light of the broader circumstances at the time. However, government has released guidance over a number of years, and they consistently refer to 5 factors, the most important and obvious of which is national security. But it also encompasses competition, where the government will favour diversity of ownership, both domestically and globally. It will require consideration of the impact on the economy for employees, creditors, but also other businesses in Australia's supply chains. The character of the investment is relevant, the investor is relevant, and in this they will consider whether the investor operates on a commercial basis and whether they're subject to adequate and transparent regulation and supervision in their home jurisdiction. And then there's a broad catch-all for other categories, and I think most people on this call, at least hopefully, will be interested in the taxation aspects. And although these considerations are broadly the same for all investments, they are applied more stringently in sensitive cases, such as where the investor is a foreign government or the investment is in Australian agricultural assets or residential real estate. So with that broad framework in mind, I'll turn to the question of identifying those entities that are subject to this regime. Now, the first category, as I've already mentioned, is foreign governments, which are fairly easy to identify, but it also needs to be borne in mind that the definition includes entities in which foreign governments hold substantial interests, being an associate inclusive 20% interest. Now, this would typically include investment vehicles in which government investors have put money, for example, a foreign hedge fund or a private equity firm. However, in June, it was proposed that passive investment vehicles be excluded. So in this sense, a fund, being a corporation, unit trust or limited partnership, where investors' funds are pooled and investments have no influence over individual investment decisions, will be excluded. Foreign inbound investors are generally fairly easy to identify, as they will be non-Australian. But there are a number of curiosities in the application of this rule. For example, a non-Australian company will not be foreign where it's wholly owned by an Australian natural person. And yet, if that foreign company had a wholly owned subsidiary, even if that subsidiary was based in Australia, that subsidiary would itself be foreign. And that's not the only unusual result that you get with the foreign person test. Australians with outbound investments can also be caught. Many cases where trusts have discretionary powers as to the distribution of income or capital will result in that trust being foreign. And that's because each beneficiary is taken to hold an interest in the trust equal to the maximum percentage of the income or capital to which they could be made entitled. So where there's a discretionary power, trustees will typically have the capacity to distribute 100% to each beneficiary. And therefore, if there's a single foreign beneficiary, even if they are a distant relative, even if they're just a potential object that may never receive a distribution, that trust will be caught. So it becomes very important in the case of discretionary trusts to carefully identify the class of eligible beneficiaries and to determine who's within it. Similarly, people will often deal with this problem by excluding foreign persons as defined in the FIRB Act. Trusts can also pose a problem for listed and widely held companies, which may be able to determine the address of their shareholders, but won't be able to scrutinise particular powers of the trustee or the class of eligible beneficiaries to determine whether or not they're foreign. Now, given the practical impossibility of conducting this kind of review, in most cases, companies are in an unenviable position of having no sure way of testing whether they're foreign, although I'm not aware of Treasury applying compliance resources to this particular issue. Unless you think the national interest test would save an Australian entity that is foreign for some reason, our experience is that anyone subject to this regime will be treated as foreign, irrespective of how remote their connection to a foreign person is. And finally, I'll note that dual listed groups are also foreign, with BHP being the most notable example. However, the Treasurer doesn't need to be notified of all actions proposed to be taken by foreign investors. There are monetary thresholds and proportional thresholds. So, for example, if the dollar value of a transaction is below a threshold, there is no need to notify. Similarly, an interest of less than 20% typically would not require notification. Although these tests vary depending on the type of investor or the type of asset. So government investors typically will receive strict scrutiny. Similarly, investments in residential real estate. However, in response to concerns that foreign investors would take advantage of depressed asset prices caused by the pandemic, all monetary thresholds have been temporarily reduced to nil, which greatly expands the scope of the foreign investment regime. Fortunately, for some, monetary thresholds for non-sensitive lease renewals were reintroduced from 4 September, and the proportionate thresholds remain unchanged. So it's not the case that all transactions by foreign persons will be notifiable, just a larger class for the duration of the pandemic. Another new measure proposed in June was to broaden the powers available to the class of national security actions, which will allow the Treasurer to review transactions in relation to national security land or national security businesses, which would otherwise escape review. And this is dealing with assets like ports, electricity assets, other kinds of utilities or defence contractors. And each of these will require notification irrespective of the value or the level of interest. Another suite of proposals in June included the power for the Treasurer to call in proposed acquisitions for review, although it is noted that this power is expected to be used sparingly. And finally, there's even a last resort power to enable the review of actions where a no objection notification is being given, although in our experience, no objection notifications are incredibly rare. Conditions will usually be applied. Where it is necessary to notify the Treasurer of proposed action under the foreign investment regime, the notification will not be taken to have been received until the relevant fee is paid. Fees are imposed on investors to ensure that foreign investors bear the cost of the administration of the regime rather than Australian taxpayers, and can range from several $1,000s up to $500,000 for certain acquisitions. Now, the application itself should deal not just with the mere fact of the acquisition, but should address the national interest test as completely as possible. And this is critical because no action can be taken until an approval is received. Now, Ordinarily, the decision ought to be made within 30 days. However, as a result of the removal of monetary thresholds that I've discussed, this period has been extended to 6 months. Further, applicants can request extensions to these time limits, and it's usually the case that if the Treasurer hasn't made his decision within that time, the applicant will make that application, because absent that application, there will be a deemed disallowance. In our experience, though, it is common that the Treasurer and the underlings will give fairly rapid consideration to all of these matters. So if there is a delay, it's typically caused by needing to look at something in particular rather than just going slow. If a foreign investment isn't prohibited, the Treasurer has 2 options. There can be a no objection notification without conditions, which, as I've mentioned, is extremely rare, or they can issue a no objection with conditions, and the Treasurer is free to impose whatever conditions he considers necessary to ensure the investment is not contrary to the national interest. Now, as I've said, that power is unconstrained and is being used more and more frequently to assist the tax office. The tax conditions are now applied to virtually all no objection decisions. The first and most significant is the requirement to comply with Australia's taxation laws. There is an exception that states that a taxpayer will not breach this condition if it's taken reasonable care and has a reasonably arguable position. However, this could result in a double penalty for taxpayers if they fail to take reasonable care, or if the position they've taken isn't reasonably arguable, once under the administrative penalty regime in the Taxation Administration Act, then again under the equally draconian FIRB penalties that I'll be addressing at the end of this talk. We've also seen conditions requiring notification of what method taxpayers will use to determine their maximum allowable debt amount under the thin cap regime, which seems to me at least to be an odd question given that choice is made annually. It's also common for the conditions to require good faith negotiation with the tax office, which is particularly relevant in a transfer pricing context where parties are negotiating an advanced pricing agreement. It's also common to see a requirement for registration and to update various authorities, whether it's the ACCC or the tax office, of compliance with other conditions. Further conditions have also included, for example, the requirement for the head office to remain in Australia after the acquisition, or for development or further investment to occur within a particular time. So obviously problems can arise at any stage. A foreign person might, for example, take an action without having received approval. Now, this isn't only in cases where purchasers are rushing to complete a transaction, but while they feel that the review process is taking too long, can also result from an entity not realising that it's foreign and taking the action nonetheless. Problems may also arise because of defects in application. Although there's currently no mechanism to allow the Treasurer to address defects in applications, under the measures proposed in June, the Treasurer would be allowed to revoke approvals that were based on false or misleading information. And of particular relevance is the inclusion within the definition of false or misleading of omissions of fact. So going forward, it's going to be incredibly important to ensure that all statements made throughout the application process are not just accurate, but sufficient to give a complete understanding of the transaction and the broader situations. Finally, breaching conditions is obviously going to cause problems. And in June, it was proposed that the Treasurer be allowed to issue directions if he has a suspicion that a foreign investor has or might breach a condition. And this power is intended to provide a quick and efficient mechanism for protecting the national interest from further or ongoing harm. Now, as important as identifying what could go wrong is understanding the potential consequences when something does go wrong. Now, I've already mentioned that the Treasurer can prohibit an action from being taken. But in the event that something has gone wrong, he can actually order the disposal of an asset within a particular time frame. I've also alluded to the power to make directions. Now, in addition to these, the Treasurer can bring actions for criminal and civil penalties for breaches. And this is the area that has seen, I think, one of the most significant changes in the June proposals in relation to the penalties that are available. For criminal penalties, they range now up to imprisonment for up to 10 years or a fine of $3.3 million or both. Civil penalties are even more extreme. They've gone from $66,000 up to a maximum of $550 million. These penalties are seldom applied, but for whatever reason, the government has thought that it's necessary to have an even bigger stick in order to deal with the potential risks to the national interest that are posed by foreign investment. However, it's not all bad news for foreign investors. Less serious offences can be dealt with by infringement notices. While these have historically only applied in relation to residential land, the proposals made earlier this year will extend that to all breaches under the foreign investment regime. As these are administrative in nature, there'd be no requirement for the Treasury to take an investor to court and would give a broader range of options to respond to these less serious breaches. And that can also be seen in the level of penalties, $66,000 for individuals and $333,000 for corporations. And I think we can all hope that this draconian penalty regime will seldom need to be used. I think people are generally sufficiently aware of the importance of getting their FIRB compliance right, that the focus is on the front end application process rather than in cleaning up problems. Well, thank you all for your attendance and attention, and I'll hand back to Paul to deal with any questions that might have arisen.
Thank you very much, Mark. And again, thank you, Zoe. We have a few questions, and let me see now. Zoe, perhaps I might put this question to you. You mentioned that the test for the foreign surcharge in Victoria for land tax is different to the test for the duty surcharge. How does the foreign surcharge for land tax apply in Victoria? Can you just clarify that for us?
Thanks, Paul. In Victoria, the test for whether a land tax surcharge, which is referred to as the absentee owner surcharge, is whether there is a specified beneficiary of the trust as a foreign person. Now, what a specified beneficiary is actually a defined concept in the Land Tax Act, and it means any person or entity that is specifically named in a trust deed as a beneficiary to whom any income or capital of the trust can be applied to. So it's not actually limited to the default beneficiaries, and a person can also be a specified beneficiary or specifically named if they're separately appointed or nominated under a separate deed of appointment or nomination. Also in Victoria, if the trustee is an absentee or foreign trust, the surcharge applies to all land held by the trust. It's not limited to residential property. This is different to the situation in New South Wales, where the tests are the same for duty and land tax surcharge, and in New South Wales, it would only apply to residential property.
That's great. Thanks, Zoe. Let me see now. Perhaps another one for you as I sift through. You mentioned issues with stamp duty and variations just briefly. Can you just sort of elaborate a bit more about how could the stamp duty apply to variations that you might do to exclude foreign beneficiaries?
It's a good question. As a general statement, if a trustee unilaterally varies a deed to remove foreign beneficiaries, it's unlikely to be subject to duty in Victoria or New South Wales. However, care should be taken that that variation deed does not of itself constitute a declaration of trust, which is something that can usually be appropriately drafted and managed. However, as to where duty can apply and effectively which state legislation you need to consider, it actually turns on where the trust holds assets. So, for example, if the trust holds assets in Queensland, then you need to consider whether there could be any Queensland duty. For example, if the variation affects the interests of any takers in default. This is the case even if the deed was declared in Victoria or New South Wales. So the situs, or the legislation you need to look at, is determined by the assets. Further, if a foreign person is specifically named in the deed or the person that is the primary beneficiary upon which all other classes of beneficiary essentially are derived from, then this can complicate the matter, and you might need to turn your mind to whether this causes a resettlement, or in other words, the cessation of one trust and the creation and declaration of a new trust.
Thanks, Zoe. Now, Mark, this is sort of a vexing question, at least for me. in the FIRB context, are the tests for identifying foreign persons the same for FIRB as they are for stamp duty and land tax in the various jurisdictions where there's an identification or a regime to deal with foreign persons?
The best that we can hope for is that the state regimes are the canary in the coal mine, because the tests are, with the exception of New South Wales, not even close in many respects. They do apply quite differently. Indeed, there isn't even, I think as Zoe's mentioned, consistency within the states as between their own duty and land tax tests for who's a foreign person. And indeed, while New South Wales borrows from the FIRB definition, it modifies it in a number of ways in relation to Australian and New Zealand citizens, although more favourably. I think the most important thing for people to be aware of is that falling outside of one regime won't necessarily mean that no other regime applies. So for example, if land's being acquired, it will generally be necessary to review a trust deed in a lot of detail. It might require a discussion with some of the key beneficiaries to determine whether they have any family members who are living overseas who might be foreign, or if they have any other foreign investments that might potentially be within that class of eligible beneficiaries. So these considerations, I think, need to be done on a case-by-case basis and having regard to the rules, not just for FIRB, but also for the particular state or territory in which the land is situated.
Thanks, Mark. Just looking at another question that's come through for you. Yeah. You mentioned that the timeline has been increased from 30 days to 6 months for most FIRB reviews. From your experience or from our experience, how often are reviews actually completed within those timeframes?
Well, there aren't any hard or fast rules. That the decision period itself is fixed, but there's obviously an unlimited number of extensions that can be sought. In our experience, 30 days is achievable for uncontroversial actions, particularly if they're part of a series. So for example, if a client has acquired land and previously notified FIRB and received an approval, that any subsequent acquisitions could be dealt with in a fairly rapid way. Now, roadblocks do sometimes come up where there's changes in standard conditions. As I've mentioned, there has been an evolution over the last few years of the kinds of tax conditions that we've seen applied. And there's not always a great degree of discernment in the application of those conditions. So for example, where a trust is acquiring land, there might be a question put to the taxpayer or a condition around membership in a consolidated group or being the head company of a consolidated group, which isn't necessarily relevant. So there can be delays in engaging both with FIRB or with the tax office to resolve those issues. And it can be particularly exacerbated where Treasury is the body considering the application and the ATO is the body that's considering the conditions, because the body that you're discussing things with, Treasury, are essentially a PO box between you and the tax office. But at the same time, in our experience, they are dealt with fairly rapidly, and it's not in Treasury's interest to delay matters, because as I've mentioned, and as the government will always point out, foreign investment is crucially important for Australia, and it is important that Australia remain both open for foreign investment and be seen as an attractive investment opportunity.
Thanks, Mark. You see another question's come through for Zoe. This is about land tax waivers, Zoe. How do you actually apply for a land tax waiver in Victoria?
It's not too tricky. For both the 25% and the 50% waivers, essentially you make your application through the My Tax online portal, which is on the Victorian State Revenue Office website. So for most people, it's pretty easy to sign up to that. All you need is, a couple of personal details and the most current assessment for your assessment number. But once you're on there, on the website, there are various forms that need to be completed, including declarations from the tenant that they satisfy the eligibility criteria. For which for most commercial tenants is that they are eligible for and participating in the JobKeeper program. You'll also need to lodge evidence of the rent reductions provided, and this might require you to provide copies of any agreements for the rent reduction and copies of the relevant lease agreements. As part of that waiver application, this is where landlords could also ask for the deferral of the balance of their 2020 land tax assessment. There is also a very limited automatic deferral that I didn't discuss, which is relevant to landowners that own at least one non-residential property and have a total taxable land holding below $1 million. For those landholders, there is a full deferral of their payment of their 2020 land tax assessment until March next year. My understanding is that landowners that are in this category were contacted directly and the deferral's been applied automatically. Of course, these landowners could choose to pay their 2020 land tax if they didn't want the deferral to apply.
Great, thanks, Zoe. Look, that's probably a time for us now. So look, in concluding, thank you very much, Zoe. Thank you, Mark. Look, a quick but valuable survey of these two areas that, as you've heard, have connecting threads in the statutory definition of who is foreign and who is not, whether the state duty surcharge or the FIRB regime. And, what we've sort of heard is trusts, that might appear to be entirely domestic, can be considered foreign, which draws you into the regime and then subject to sort of exclusions or proportional, either in quantum or proportional. And look, as both Mark and Zoe have pointed out, getting it wrong, can have onerous consequences. As both Zoe and Mark, have suggested, there are perils in the shadows with these rules, and they need to be considered carefully and properly. Well, look, that concludes our current webinar series, Quick Takes on Tax. If you have missed any of our previous 3 sessions dealing with international tax issues with trusts and CGT, or the transfer of trust rules in Section 99B and Section 100A, they can be accessed via the Arnold Bloch Leibler website or on YouTube. If you just do a search on YouTube, you'll have a fascinating hour or so looking through all of that. Look, thank you to our marketing and IT teams at ABL for their assistance with presenting these webinars. Importantly though, thank you to all of you for attending this ABL webinar series. Stay well and stay healthy. We have further webinars in the pipeline, and we hope you will join us all soon for our next one. Thank you very, very much, and good afternoon.